Something seismic shifted beneath the global financial system, and while most people were distracted by everyday worries, the foundations of the dollar quietly began to crack. On November 15, 2024, a move was made that may ultimately reshape the financial future of everyone holding US dollars. In a calculated and nearly invisible operation, China began unloading roughly $3 trillion worth of US-linked assets. There was no press conference, no dramatic announcement, just silent execution. And if your savings, income, or retirement are tied to the dollar, as they likely are, you need to understand what this signals. This isn't speculation or internet fear bait. It's unfolding in real time. While headlines focused on inflation numbers, elections, and cultural noise, China initiated what could be the opening maneuver in the largest financial confrontation the modern world has ever seen. The battlefield isn't tanks or missiles. The weapon is currency, and the target is the US dollar. To grasp the magnitude of what happened, we have to start with the details most media outlets are ignoring. In the corridors of global finance, where power is exercised quietly, China's central bank, the People's Bank of China, began orchestrating a massive reduction in its exposure to U.S. Treasury securities. This wasn't symbolic. This wasn't gradual trimming. We're talking about a scale so large it rivals the economic output of entire nations. $3 trillion is not just a number. It exceeds the GDP of many advanced economies. It represents more wealth than the combined market value of the world's largest corporations. And crucially, this sell-off didn't happen in the open. It was routed through intermediaries, layered across sovereign funds, offshore structures, and indirect channels designed to avoid panic and attention. How do we know? Because capital flows leave footprints. Federal Reserve custody data, Treasury International Capital reports, and global settlement figures tell a story that's impossible to ignore. The conclusion is simple and unsettling. China is methodically distancing itself from the dollar-based system. At first glance, this might not sound alarming. Countries buy and sell bonds all the time. But this isn't just about bonds. It's about the architecture of global money, and what happens when one of the largest players decides to exit. For half a century, the US dollar has sat at the center of global trade. Nations transact in dollars even when the US isn't involved. Energy, commodities, shipping, debt, dollars grease the wheels of the entire system. This structure was cemented in the early 1970s when the US abandoned the gold standard and forged agreements that required oil to be sold exclusively in dollars. From that point on, every country needed dollars just to function economically. That status granted the United States an extraordinary privilege. While other nations had to produce real goods to earn foreign currency, the US could create money at will, confident the world would absorb it. It was an unprecedented advantage, but one built entirely on trust. And that trust has been steadily eroding. Over the last few decades, the U.S. expanded its money supply aggressively. Wars, bailouts, stimulus programs, ballooning deficits, trillions were created to paper over structural problems. At the same time, access to the dollar system was weaponized. Sanctions froze reserves. Payment systems were shut off. Assets were seized. The message to the world was clear: the dollar is not neutral. China noticed. For years, Beijing observed, planned, and prepared. What we're witnessing now isn't an impulsive reaction, it's the execution phase of a long-term strategy. Selling U.S. assets is only one piece. The larger goal is to reduce dependence on the dollar entirely and replace it with a parallel system where China plays the central role. This effort isn't happening in isolation. China spent over a decade cultivating alliances, particularly through the BRICS framework: Brazil, Russia, India, China, and South Africa. Together, these nations represent a massive share of global population and production, and the bloc is growing. When BRICS expanded to include major energy producers and strategically important economies, it marked a turning point. Countries once central to the dollar-based system began openly exploring alternatives. At the same time, China accelerated bilateral trade agreements that bypassed the dollar altogether. Local currencies are now used directly between trading partners, supported by swap lines that make the dollar unnecessary. But perhaps the most critical component of China's strategy is gold. While the U.S. expanded debt and currency supply, China quietly accumulated physical gold. Official figures significantly understate the true holdings, according to many analysts. What matters isn't the exact number, it's the direction. Gold is fundamentally different from fiat money. It can't be created digitally. It doesn't rely on trusting governments. It has served as money for thousands of years. If a currency is partially anchored to gold, it immediately gains credibility. Imagine a scenario where China announces a framework allowing its currency to be exchanged for a fixed quantity of gold. Suddenly, the calculus for every central bank changes. Holding dollars backed by debt becomes far less attractive than holding a currency tied to a tangible reserve. This is why China is reducing its dollar exposure now, before such a shift becomes explicit. Once confidence breaks, moves accelerate. If other nations conclude that the dollar's dominance is ending, they won't wait politely. They'll rush to protect themselves. Central banks around the world collectively hold enormous quantities of U.S. debt. A synchronized sell-off would overwhelm the system. The consequences would cascade quickly. First, interest rates in the U.S. would surge. The ability to borrow cheaply exists only because global demand for dollars and treasuries remains strong. If that demand fades, higher yields will be required to attract buyers. Mortgages, car loans, business credit, all would become far more expensive. Asset prices dependent on cheap credit would fall. Second, inflation would intensify dramatically. Dollars currently held abroad would flow back into the domestic economy, increasing supply without increasing production. Too much money chasing the same goods leads to rapid price escalation. In extreme cases, this dynamic spirals into hyperinflation, eroding savings at breathtaking speed. Third, living standards would decline. The U.S. currently consumes far more than it produces, relying on imports subsidized by dollar dominance. Without that advantage, imported goods become expensive, wages lag behind prices, and purchasing power falls. Fourth, the government faces a fiscal reckoning. Servicing an enormous debt load becomes increasingly difficult as borrowing costs rise. Choices narrow to painful austerity, monetization, or default, each with severe consequences. At this point, many assume policymakers will intervene, but options are limited. Drastic rate hikes risk economic collapse. Capital controls undermine confidence. Negotiations offer little leverage when the opposing side holds the stronger position. This is how reserve currencies historically decline, not overnight, but faster than expected. History offers precedents. The British pound once ruled global trade. Its decline wasn't theoretical. It happened within a few decades, reshaping global power structures. What's especially troubling now is the compressed timeline. Based on current trends, de-dollarization momentum, commodity-backed currency discussions, and asset relocations, the next several years could be decisive. Most people remain unaware, while institutional players quietly reposition. Those with early access to information are already diversifying. Hard assets, international exposure, and alternatives to fiat are being accumulated behind the scenes. So what can individuals do? First, recognize that cash alone is not protection. Holding wealth entirely in a depreciating currency guarantees loss over time. Diversification is no longer optional. Second, consider assets with intrinsic value. Precious metals stand out because they exist outside the financial system. Physical ownership matters. Paper claims are only as reliable as the institutions behind them. Third, real assets like land and property provide utility regardless of currency regimes, especially when debt is managed conservatively. Fourth, productive businesses, those that generate essential goods and services, tend to endure monetary upheaval better than speculative or highly leveraged entities. Fifth, limited exposure to decentralized digital assets can function as a hedge, provided it's approached with caution and self-custody. Sixth, international diversification reduces reliance on any single government or currency. Geographic spread isn't about abandoning one's country, it's about resilience. Finally, skills adaptability and community become invaluable during systemic transitions. Financial capital matters, but human capital often matters more. Many ask why this isn't headline news. Part of the answer is complexity. Monetary shifts are slow, technical, and don't lend themselves to sound bites. Another part is incentive. Panic accelerates collapse. Silence buys time. We've seen this pattern before. Warnings are dismissed until reality forces acknowledgement. The decline of a reserve currency isn't an opinion, it's a process. Data from global reserves, trade settlements, and central bank behavior confirms the trajectory. The dollar's share of global reserves continues to shrink while alternatives grow. None of this means collapse is inevitable tomorrow, but the direction is clear. Preparation doesn't require panic. It requires awareness and action. The quiet exit of trillions in assets is not an accident, it's a signal. And signals matter most before the crowd reacts. History rarely announces turning points with clarity. They're recognized only in hindsight. But for those paying attention, the signs are already visible. The question isn't whether change is coming. The question is whether you'll be positioned before it arrives.